All right, everyone. Well, it is 12 o'clock. Welcome to another Geneseo Chamber of Commerce Lunch and Learn. Today we have Mark Grywacheski with the Quad Cities Investment Group joining us. Mark is an investment advisor with the Quad Cities Investment Group. He's an expert in market volatility, market analysis, and risk management. Mark's also currently the president of the Geneseo Chamber of Commerce. So, we've worked with Mark quite a bit throughout the pandemic to discuss the economic impact that the pandemic has had on our communities and on the country. And so it's our pleasure to introduce Mark to everyone, and thank you everyone for tuning in and spending your lunch hour with the Geneseo Chamber. We appreciate that. At the end of Mark's presentation, there will be time for a Q&A session. So if you have any questions, please save them until the end. And with that, Mark, I yield right over to you, and you can take it away.
All right. Thanks, Zach. How does my voice sound? All good?
Yep, sound good.
Okay. Well, first off, thanks, Zach, very much for the invitation to speak today at today's chamber event. And good afternoon, and everyone. Thanks for joining. This should probably last about 25, 30 minutes, and at the end, I'd be more than happy to have a Q&A session. It has been exactly 5 months to the day since I gave my first economic analysis back on April 2nd. Obviously, a lot has changed, and hopefully this provides some clarity on our current economic landscape. For this agenda, I'll provide my thoughts on a number of issues that's probably on everyone's mind. First, the ongoing surge in the U.S. stock markets from that historical sell-off we had back in February and March. Then I'll discuss the economic fallout from the COVID-19 pandemic, the current road of economic recovery, and then finally I'll wrap it up with a more expansive post-COVID-19 outlook. This graph here is a year-to-date performance of the S&P 500 as of yesterday. And as we can see, from February 24th to March 23rd, in less than 1 month, the S&P 500 lost almost 31% of its value. And we saw similar sell-offs in both the Dow Jones Industrial Average and the NASDAQ. And the reason for this historically fast sell-off was simple. The financial market said, look, we don't need to wait for any economic data to tell us that this virus will have a sudden, drastic, and brutal impact on the U.S. and global economy. We're simply going to sell off hard and fast now. But as we can see, coming off that March 23rd low, stock prices have indeed soared. Now, there's been basically three main stages to this current market rally. In late March, early April-ish, we looked at other nations that were the first to get hit by this virus and realized that we wouldn't get that worst case scenario for the U.S. economy. Yes, the impact would be drastic, but the U.S. economy wouldn't be shut down for 9 to 12 months or even longer. We then saw this transitory shift that technology would have in our work and daily lives. And it just wasn't the various ways we were now using technology. But more importantly, it was the speed with which we adapted. And this sudden compression of 2, 3, 5 years worth of technological usage and reliance has not only sent the stock prices of technology companies soaring, it's also helped lessen the economic fallout of government-imposed business closures and quarantines. And then finally, we do continue to see growing evidence of a very strong economic recovery. Now, before we start getting into the details about the economy, this next graph here shows the impact that those technology stocks are having on the stock market. And this graph shows the year-to-date returns for each of the three main stock market indexes, the Dow, the S&P 500, and the NASDAQ. Now, on March 23rd, the low point of the COVID-19 sell-off, the Dow was down 34.9%. The S&P 500 down 30.7%. The NASDAQ down 23.5%. But then we see the year-to-date performance as of yesterday's close. The current year-to-date performance, highlights the impact these tech stocks are having within each index. The Dow has very few tech stocks. The S&P 500, which does include a fair number of these tech stocks, including some of the biggest tech companies in the nation, such as Facebook, Amazon, Apple, Microsoft, Google. And then finally, the tech-heavy NASDAQ, which does have an abundance of those tech stocks within its index. And as we can see, the greater the number of tech stocks within each index, the greater the performance has been. Now, looking at these year-to-date returns, some of you might be saying, why is there this tremendous disconnect between the current economy that we're in right now in the stock market? Yes, the economy is in what you can consider recovery mode, but admittedly, we've still got a ways to go. However, the S&P 500 and the NASDAQ continue to break all-time record highs almost on a daily basis. Well, the answer is twofold. First, it's the performance of those tech stocks has certainly helped carry the overall market higher. For example, Amazon's second quarter sales were up a massive 40% from the second quarter of 2019. Zoom, which has now become almost the standard form of business meetings, case in point, that's what we're using right now. Zoom has seen its stock price rise from $68 on January 1st to over $457 as of last night. But even more importantly, we need to understand that, the stock market is a very forward-looking entity. So even though Wall Street, realizes that we probably won't get back to those pre-COVID-19 levels of economic growth for, maybe another 1 to 2 years, there is this growing optimism that the future outlook for the economic recovery looks very strong, and the stock market is simply reflecting that optimism. Now, at the start of the year, many economists were projecting the economy to grow by, 3.5% this year, which would have been the fastest pace of growth since 2004 and 2005. What tailwinds did we have? Well, we had the global economy was expected to begin to at least stabilize. At the end of 2019, in December of last year, we wrapped up our two biggest trade disputes. China, we renegotiated a new NAFTA trade agreement with Canada and Mexico. Also, consumer spending, which is the key driver of the U.S. economy, was expected to remain strong, fueled by high consumer confidence, a strong labor market, strong wage growth. But obviously, the COVID-19 pandemic, has had the most sudden and drastic impact on the American and global economies in history. The worst of the COVID-19 economic fallout was in April at the height of the government-imposed business closures and quarantines. And very few sectors of the economy were spared from the resulting fallout. And we can see the extensive damage that was done to the U.S. economy. If we look at this graph of U.S. economic growth over the past few years, a very dismal March drove first quarter economic growth into negative territory for the first time since 2014. And if you take a closer look at that January through March quarter, really that negative 5% growth rate is literally being derived from the last few weeks in March, when those government-imposed mandates were first initiated. Then in the April through June second quarter, economic growth fell by 31.7%, the largest quarterly decline on record. The previous largest decline was a 10% decline back in the first quarter of 1958. Now, as I alluded to earlier, the bulk of that second quarter decline was in April, and in May and June, we started to see initial signs of recovery, but I'll get into that in a moment here. But with the COVID-19 fallout, we also see the impact in the U.S. labor market. The national unemployment rate shot up to 14.7%, the highest unemployment rate for our country since the 1929 through 39 Great Depression. But look at this graph. Just 2 months earlier, in February, we were literally celebrating the strongest labor market in 50 years with an unemployment rate of just 3.5%. Next, let's look at the monthly job gains. From 2017 through 2019, the U.S. economy added more than 6.5 million new jobs. But in just 1 month in April, the economy lost 20.8 million jobs. Not only was this the largest monthly decline in American history, but it wiped out all the job gains for the American economy for the past 10 years. And we can also see the impact in the retail industry. This graph here shows the year-over-year change in retail sales. Now, as we entered 2020, retailers were set for another strong year. We had, again, a very strong economy, record low unemployment, rising wages, high consumer confidence. In January, retail sales grew by, 4.9% over the prior 12 months. 1 month later, in February, that growth rate was 4.5%. But as with most of the COVID-19 economic data, the worst of the fallout for retail sales was in April, when retail sales fell by a record 19.9% from April of 2019. We can also see the COVID-19 impact on our nation's industrial output. Now, industrial production, basically includes output, primarily from manufacturing, but also to some extent mining and utilities. And industrial production declined by 12.8% in April. Again, the largest monthly decline in industrial production on record in the past 101 years. Now, look, I could easily spend the next hour or so going over the impact to other sectors and subsectors of the economy, but you begin to see the breadth and scope of impact these government-imposed mandates have had on the U.S. economy. Now, back in April, I projected we would have more of a sharp V-shaped economic recovery rather than the more typical U-shaped recovery, which has that extended period of economic stagnation we can see, followed by a very slow economic recovery. And my reasons for that were the following. First and foremost, the acceleration of new cases in China, Japan, South Korea, which were those initial hotspots in the outbreak, had already peaked. And even though, this would still be a brutal economic event, it indicated to the financial markets that we wouldn't get that worst case scenario where the American economy would essentially be in lockdown for 9 to 12 months or longer. Next, were the unprecedented measures implemented by the Federal Reserve, President Trump, and Congress to minimize the economic impact and provide liquidity and backing to the capital markets. And finally, and this is very important to recognize and doesn't get enough coverage for its importance. Most economic downturns are actually preceded by economic weakness. You know, if you look at the 2007, 2008 global financial crisis, or the dot-com bubble, or the savings and loan crisis, or even, go back further to the oil and energy crises of the 70s and 80s, each of those downturns was triggered by a sudden external shock, and that external shock exposed some structural deficiency within our economy. But that's not the case with COVID-19. We're coming off a very strong economy and an even stronger labor market. And this economic decline is not caused by some weakness, but or structural economic weakness, let me say, but by a virus, and more specifically by governments and societies' responses to this virus. Now, again, the worst of the economic fallout was in April, and since then we've seen this very consistent, broad-based economic rebound coming off those April lows. So, all of you might be asking yourself, okay, what evidence are we seeing that indicates that the U.S. economy is in, quote unquote recovery mode? Again, let's look to the labor market. The national unemployment rate has steadily improved to 10.2%. Monthly job gains. In July, 1.8 million new jobs were added. In the last 3 months, we've recovered about 42% of the 22 plus million jobs we lost in March and April. Let's look to retail sales. In July, monthly retail sales totaled over $536 billion. This is a new all-time record for retail sales in a single month, and even exceeds the prior record of $530 billion set this past January. Put it this way, this means that retail sales in July, just months after the largest economic fallout in American history, are now higher than they were before the COVID-19 pandemic. We're also seeing this surge in residential housing, manufacturing, and many other facets of the U.S. economy. Now, as a caveat, this surge in retail sales has been somewhat uneven across the 13 retail subsectors. The biggest year-to-date gain has been among non-store retailers, which primarily consists of online retailers, such as Amazon. From January to July, non-store retailers have seen their sales increase by 23.4%. And again, Amazon's second quarter sales up 40% from the second quarter of 2019. Now, for the July through September third quarter, we continue to see a wide range of estimates for economic growth, but I think there's growing consensus around a plus 20 to plus 25% growth rate, which does represent a significant recovery from the second quarter growth rate of minus 31.7%. But more importantly, it shows the sheer veracity of this current economic recovery. Now, obviously, the farther out we try to project, the less clarity there will inherently be, and a lot of unknowns and uncertainties still exist. Will there be any escalation, de-escalation of the COVID-19 virus itself? What will be the extent of government mandates? That are they lifted or added to? We have a very important presidential election in 2 months. What will be the path of economic growth for the global economy, specifically our key trading partners of China, Canada, Mexico, the European Union? But absent any seismic shift in any of these, The financial markets focus will be on the core components that drive economic growth. Now, I showed this graph at the last presentation back in April, but I think it's worth showing again. This graph shows the four basic components used to calculate and actually quantify U.S. economic growth. The first is consumer expenditures, the day-to-day consumer spending on food, clothing, cars, household goods, and we can see it accounts for a massive 68% of America's economic growth comes from consumer spending. The next biggest fixed investment, which is broken down into two sectors. Business investment, the bigger of the two, which is the big ticket purchases by businesses of factories, equipment, and technology. And then to a lesser extent, there's consumer residential housing. Next, there's government spending. And finally, net exports and imports. And as you can see, this is typically negative and actually subtracts from economic growth because as a nation, we do tend to import more foreign goods than American goods we export out to other nations. Now, when we talk about the outlook from this fallout, well, we need to distinguish between quote unquote recovery mode, which we're currently in, versus getting back to those pre-COVID-19 levels of economic growth. And even though Wall Street realizes a lot of variables and unknowns stand in the way of a full economic recovery, there's tremendous optimism for the strength of this current recovery, and here is why. This is worth the price of admission. As I just pointed out in the previous graph, consumer spending drives nearly 70% of our nation's economic growth. Again, in July, retail sales reached a record high. We continue to see further evidence of a strong rebound in the housing market and other indicators of consumer spending. But here's the takeaway. Wall Street realizes that consumer spending can help overcome a lot of deficiencies in our economy. For example, let's look back to 2019. Just last year, despite the weakest global economy in over 10 years, despite our global trade disputes with our largest trading partners, we still had a very strong economy. Now, these obstacles I just mentioned did weigh heavily on many parts of our economy, such as business spending, capital expenditures, and manufacturing. But it was a very strong consumer spending that allowed the U.S. economy to overcome these challenges. In fact, in 2019, last year, the American consumer was the near de facto driver of the U.S. economy. And as we go into 2021, Wall Street realizes this will once again be a very uneven recovery, with some sectors lagging behind, as it did in 2019. But if consumer spending remains strong enough, it can once again carry the load of economic growth as it did back in 2019. And you're seeing this optimism that the American consumer can drive this recovery forward, being reflected in the continued rise of the U.S. stock markets. Now, when we analyze the economy, what we do is we analyze bits and pieces of economic data and then try to, extrapolate a broader economic landscape. But the challenge isn't to simply, quantify the economic fallout from the virus, but more importantly, to assess the path of recovery. Now, as I mentioned, back in April, I did project we'd get a sharp V-shaped recovery. But for the past few months, I've since been advocating for what we call a square root shaped recovery, obviously named after the shape of the mathematical square root symbol. Now, very similar to the V-shaped recovery, the square root recovery also experiences that sharp initial economic rebound. However, with the square root recovery, this initial rebound eventually reaches a plateau, falling short of full economic recovery. The rate of economic growth would then level off, still rising, but at a much slower gradual pace until that full economic recovery is eventually realized. And here's the reason why I made this shift from a sharp V shape to this square root shaped recovery. We still have a number of states and major metropolitan centers around the nation that are still less than fully open, and that will continue to act as a drag on a full 100% recovery. Now, if you look at this square root shaped recovery, what we don't know right now is if this initial surge that we're currently in, will it take us to a 50% recovery, 75% recovery, or a 90% recovery? And once we do reach that plateau, will it take 1, 2, 3 years to get back to those that 100% pre-COVID-19 level of economic growth? Right now, we simply don't have that information. Over the upcoming months, as we do get more data, it will help provide clarity to those very questions. Now, that kind of sums up my presentation here. Zach, be more than happy to answer or field any questions people might have.
Yeah. First, thank you, Mark, for your insight. And one of the words I heard you say a lot was record. This is a record decline or increase, and it's just remarkable to kind of witness, visually how historic this time period for the economy is. Mark, I don't know, you can talk a little bit more on that, but I'd also want to encourage anyone, if you also have a question, feel free to write it in the chat while we're doing the Q&A. But, what would be your take from a historical standpoint as to what we're witnessing and what we're experiencing right now in our economy?
Well, it kind of goes back to what I mentioned earlier of one of the reasons why I initially projected that sharp V-shaped recovery. Obviously, as I just stated, I tweaked it a little bit from a sharp V-shaped recovery to that square root-shaped recovery. But in both of those recovery models, there is that sharp economic rebound. And as I alluded to it at the beginning of this conversation, it's the fact that unlike all the other economic declines we've had over the past 50 years, those were preceded by economic weakness. And what I mean by that, there was some structural deficiency within the American economy before the subprime mortgage crisis hit, before the oil and energy crisis of the 70s and 80s, before the dot-com bubble. There was some structural flaw and deficiency within the American economy, and that external event triggered that sudden economic fallout. But with COVID-19, it's different. We didn't have that structural deficiency and weakness before we got hit by COVID-19. We had a very strong economy. We had a very strong labor market. We had rising wages. We had very strong consumer spending. So even though we had these record, unemployment, the biggest increase in unemployment in history, the biggest monthly decline in retail sales or industrial production, all these record declines from COVID-19 in April, that fundamental strength we had going into this pandemic allowed the U.S. economy to quickly rebound. And that's exactly what we're seeing.
All right. Thank you, Mark. Does anyone have any questions for Mark?
I got a question, Zach. Mark, this is Brett Decker. I'm not on the Zoom call. I'm on a conference call, but
Oh, okay.
I'm curious, how do you have any thoughts on any airlines that are not going to be able to survive this downturn, because you just don't see the numbers flying yet, and I just don't see it come. It certainly isn't going to open up anytime soon. Do you know of any, or do you follow airlines that may, the weakest ones who just flat out might not make it, or may have to combine with another airline?
Thanks for the question, Brett. No, I've actually fielded that question from other people, and my recommendation is just, take it for what it's worth. I mean, I think there's just a lot of uncertainty with airlines, whether it's the big ones like American or United, Delta, whatever, even going to the smaller regional ones. It seems that not just from personal travel, but business travel. And when you talk to people, business trips are becoming a thing of the past. And so as far as like future revenues for these airlines, it's very hard to predict the landscape 6, 9, 12 months, or even 2, 3 years down the road if there is this fundamental shift in businesses away from travel and towards Zoom. And that's why I said, look at Zoom. Literally it went January 1st, it was at $68. Last night closed over at $435 and rising. So airlines is a very tricky industry.
What about commercial? What about commercial real estate valuations? When do you think that they don't seem to be going down yet, but I can't imagine that those aren't going to be discounted in the very near future.
As far as commercial real estate, I mean, the trend that we're kind of seeing, or you're following in the market, is that a lot of these businesses are renegotiating their leases. Some people had, a 7,500 square foot business. They're going to those what do you call them? Temporary places where you can literally rent out a conference room. So I think the residential real estate also is going to be facing its challenges as businesses are struggling to remain open.
All right. Looks like we have a question here for you, Mark. Is where do you think we are on the square root at this time? This is a message from Katie Orwig. So thank you, Katie, for your question. Mark, where do you think we're at right now on the square root?
Well, great question, Katie. As of September 2nd, I think it's hard to identify exactly what point we're at. I think as we get more information over the next few months, we'll be able to better classify where exactly we're at. If we do get that third quarter economic growth rate of plus 20, plus 25%, I think we can safely put it in the, maybe a 75% rebound. But going into the fourth quarter, there is that tremendous lack of clarity depending on the election results. So, maybe between, that 50 to 75% recovery, I think we could reach that by the end of the third quarter, if third quarter GDP does come in at plus 20, plus 25%.
Okay. Do we have any more questions for Mark at this time? Sounds like not. So, Mark, I would yield to you with any last thoughts, as well as a plug for Quad Cities Investment Group.
No, I just appreciate the time, and hopefully everybody learned a little bit of information about what's kind of been going on in the economy. Obviously, we had the worst of the fallout was in April. We do continue to see a very strong economic rebound. It kind of goes to Katie's question, and as we get more additional information, we'll be able to better quantify of do we get to a 50, 75, or 90% recovery before we kind of start to flatten out. We're only a few months past April, and the more economic data we get, the more clarity we'll be able to provide. So, but again, thanks to everybody for joining.
All right. Yeah, thank you, Mark. Again, we did record this presentation, so keep an eye on it, and we will get it out there. And Mark, I just wanted to take a minute to thank you for making time to provide this wonderful economic analysis for the Geneseo community, for the Geneseo Chamber. I also want to thank you publicly for everything you do for the Chamber, serving as our president of the board of directors. So just thank you for your commitment to Geneseo and for your insight on the economy. It's very much appreciated.
Oh, my pleasure, Zach.
All right. So again, everyone, that'll do it for today. Mark, hopefully we can check in a little later this year and see how things are doing towards the end of the year, if you're open to that.
Sure.
And and then everyone, I would just say, take care, be safe, be sure to wear a mask in a public place, and have a happy and safe Labor Day weekend, everyone. So until next time, we'll see you. Thanks for joining. Have a great rest of your day.